let's get started. So good afternoon, everybody. My name is Michelle Fitzpatrick. I am with Northern Bank. I am joined here today by John Starling and Sarah Starling. They are running our 1031 exchange division. So they are our resident experts, and today we're going to be talking about related party real estate exchanges. Just so everybody knows, this is being recorded. So, and we do send it out after we finish. So if you do not consent to being recorded, you can hang up now and we will send this to you. But if you stay on, just so you know, your name may be used in this recording. So thank you for that. Without further ado, John and Sarah, you're going to take it away.
We can take it away.
Okay. So I think what we typically start with just the basics. 1031 basics is always kind of how we start. So I'll leave it to you guys to go through it.
Yeah. So
Thank you, Michelle. Thank you so much.
This is well. First off, father-daughter team, not husband and wife. Just so we clear that up because people think that all the time.
Yeah, I'm not Bill Belichick. I do not have a 25-year-old wife. And I am quite a bit older than my daughter by 30 years. So we've been working together for probably 15 years now, or 16.
Yep.
And Sarah and I have enjoyed a father-daughter working relationship, and it's been quite an amazing thing for me to be able to bring my daughter into our business. We've been exchanging for people for over 25 years, helping people as their qualified intermediary to avoid paying tax. And we've saved millions, maybe even $1 billion worth of taxes for thousands of exchange clients that would rather reinvest their money than to pay the tax on the profit from the sale of their properties that they're relinquishing. So anyway, Sarah, go ahead and get into the code. The code is 1031, and it's just a specific code in the IRS.
This is the definition, actual definition that is in the code. It says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or investment.
And we say real property because we used to have personal property exchanges. You know, everything that's not real property is considered personal property. So airplanes and artwork and bulldozers and cars and everything that's not real property is considered personal property. You used to be able to exchange those, and now it's just real estate. And so real estate is taxed. The profit is taxed. And Sarah, if you'll go ahead and just go over the different types of taxes that we have on.
Yeah. So what is that tax? People are like, well, it's just 15%, right? It's not that. 15 is still a lot, but you've got state and federal taxes. With capital gains, you've got a 25% depreciation recapture. If you've owned a property for a long time, you've depreciated and the depreciation is recaptured at 25%. Federal is 15 or 20, depending on your income bracket. You get another 3.8 for net investment income tax. That's a federal tack-on tax that was implemented during the Obama administration to recoup Medicare and Medicaid. And then 4% for Massachusetts millionaire tax. So if you make over $1 million, a lot of people are these days, you get another 4% plus the 5% Massachusetts state income tax. So that's a lot. The majority of that pie.
Well, not quite, but
not quite. I think we need to fix 50%. That, but yes.
Yeah, it's a lot.
Yeah, we need to fix that pie chart a little bit, but it does come up to close to 40 when you add on the state millionaires tax, and it gets way on up there into the high 30s. So quite a bit of your profit gets taken by the federal government and the state government or you can reinvest that money and continue to grow your wealth faster. So the qualified intermediary basically is the middleman to allow for an exchange. Remember, the code says if you are exchanging property, then you can avoid paying the tax. But an exchange requires someone to exchange with. If you just sell to one party and buy from another, that's not an exchange, and that is a taxable event. If you hire a qualified intermediary to act as the person that you exchange with, then you get the ability and the opportunity to continue growing your wealth faster. So the qualified intermediary contracts with the taxpayer. The taxpayer is the exchanger, and he qualifies with he contracts with the taxpayer to provide qualified intermediary services. And then when the taxpayer sells their relinquished property, the qualified intermediary receives the funds, and then the qualified intermediary holds those funds until the taxpayer finds his replacement property, and then the qualified intermediary uses the funds to buy the replacement property, and therefore creating a swap. So the taxpayer sells the property initially that he's going to sell. He sells it to a third party, but it runs through the qualified intermediary so that he's actually selling it to the qualified intermediary by assignment of the contract, and then the qualified intermediary receives the funds, and then it just on the reverse side, on the second leg of the transaction, the taxpayer goes out, finds his replacement property, writes a contract to purchase it, assigns the contract to the qualified intermediary. The contract intermediary buys the property, and then the seller direct deeds it to the taxpayer. So that's just the process that the qualified intermediary goes through to tax protect the money. And obviously there are deadlines, and Sarah, let's talk about those.
Yep. So you've got from your closing date, not contract, but closing date, you've got 45 days to identify what you want to buy, and 180 days from closing date to close on it.
Exactly. So 45 days is your shopping period. And when you're shopping for your property, you can identify up to 3 replacement properties, regardless of fair market value, or you can identify more if you are intending to diversify. In other words, if you're selling one property and planning on buying multiple replacement properties, so like, for instance, an example would be if you're selling a $1 million property and you want to reinvest in 5 $200,000 properties, then you can't use the 3 property rule to identify on your 45th day what you're going to buy. So you would use the 200% rule, which says that you can identify up to 200% of the market value of the relinquished property. So in our example, if you were selling a $1 million property, you could identify up to $2 million worth of replacement properties. In our example, if you were doing that $200,000 5 properties, you could actually name 10 properties at $200,000 apiece and still be okay with your naming rule. The 95% rule is the third rule, which allows people to buy a portfolio of properties. And if the 3 property rule and the 200% rule won't work, then the 95% rule will. So in other words, if you're selling a property for $1 million and you want to buy a replacement property, and you decide that you want to buy a portfolio of properties, maybe it's got 10 properties in it, or 15 or 20, and the properties are they're obviously more than 3 properties, so you can't use that, and the 15 properties would in total add up to more than 200% of the relinquished property. The 95% rule says that you can name as many properties as you like, regardless of value, as long as you close on 95% of those properties. Okay, so we're moving along pretty quickly here because we want to get to these related party rules. Now, in that overview that we just gave you for the last few minutes, 10 minutes, are there any questions from anybody? Unmute your mic and feel free to ask a question if you're lost about what we were just talking about, because we're going to move into related party overview now. Okay.
Could you just, could you just spend 1 second talking about the depreciation recapture?
Depreciation recapture, sure.
Yeah.
So if you'll, Michelle, flip back to that tax slide, you see here federal 25% depreciation recapture. One of the biggest things that is an enticement for people to own investment real estate is that you don't have to pay tax on a big portion of the income. It's tax protected through depreciation. So depreciation is just a concept that the federal government agreed to by saying that you can depreciate a residential property over 27 and a half years and a commercial property over 39 years, so that you, and they allow you not to have to pay tax on that much money. So for instance, if we had $1 million property that we purchased and we have owned it for 10 years, we might have taken depreciation over the course of those years in the amount of, let's say, if it was a residential property, we might have taken a third of that value of that property. So 300,000 in depreciation over the course of those 10 years, 30,000 a year. And that 30,000 a year is significant because it allows you to tax protect $30,000 worth of rental income from being taxed because of the depreciation offset. The bad news is, go ahead, Jeff.
I'm sorry. Say I have a fully depreciated asset.
Yes.
What am I up against?
So now
everything's profit.
Yeah. So
right, well, I know I understand that, but so when I go to do this transaction, is the government going to be able to claw back anything else? I mean, if I have a fully depreciated asset, I have an income number every year coming from the investment property. Is there a recapture in that case, or because my asset's fully depreciated, that's the end of it?
It lowers your basis. It just lowers your basis. In
Okay,
the property.
fine. Okay, I think I understand. Thank you.
So
then,
yeah, so let's just drill into that one more second, and that is that the depreciation that you have, if you're going to do an exchange, then you don't have to pay the depreciation recapture tax. And so now, how does the federal government account for that? Well, they lower your basis in your replacement property by the amount of the depreciation that you've taken on your relinquished property. So now your basis on the new property is shifted from the old property into the new property. If you buy up in value, then you get to start taking depreciation again on the portion of the difference between the old property and the new property.
Thank you.
Okay, good question. Any other questions about the initial portion of the presentation that we just made? Okay, so now let's talk about related parties. If you're buying a replacement property, Section 1031 of the Internal Code allows investors to defer capital gain taxes when exchanging like-kind properties held for business or investment. When related parties enter the equation, additional safeguards apply to ensure transactions serve legitimate business purposes rather than avoidance of tax. Okay. So now, Sarah.
They think that they're worried about, you can get your immediate family to do what you want, right? So that's why they have these rules in place, because they, if it's unrelated, then you can't get the other party to do something that would shift your basis. But there are things that you can do related party exchanges, and we're gonna go into that. So the related party rules prevent taxpayers from manipulating Section 1031 exchanges to shift tax basis between related parties' properties and minimize taxable gains. So, but contrary to common belief, 1031 exchanges between related parties are permitted under the tax code. They simply come with additional considerations.
Can I just jump in? I think what one of the concerns would be is that if Sarah owned a fully depreciated property and John owns, as her father, John owns a property that he just bought that has a high tax basis, that Sarah tries to exchange into John's property. John sells to her, doesn't have any sort of taxable event, but Sarah has deferred her taxes. I think is that the biggest concern?
That's a huge concern because the IRS always gets cut out on a deal like that.
Yeah.
So the basis in my high property is now shifted to her. So she's got a high basis property that she can now turn around and resell in a year or two and not have to pay any tax on. So the IRS got cut out of the tax that they would normally had to get if she liquidates out in a couple of years. It's an opportunity by shifting a basis from a low basis property into a high basis property. It's an opportunity for you to cash out and not have to pay any tax, rather than having to re-exchange to avoid paying your tax.
So I
What's
think that
considered?
yeah. Sorry.
Go ahead.
No, I was
Okay.
going to say, I think that's a good segue into what's considered related.
Yeah.
So the definition extends beyond family. So your immediate family, your blood relatives, your brother, your sister, your husband or wife, your parents, your grandparents, your children. Those are all considered related within a family. Business entities, which are more than 50% ownership by the exchanger.
Sarah, can I just interrupt 1 second?
Yes.
So when we talk about immediate family, are we talking about step family, like a step brother, a stepfather, a live-in girlfriend, an aunt, an uncle, a cousin? Can you kind of elaborate on that?
Right. They're not blood related, so they're not related except for your spouse.
Okay.
Yeah.
So if they're a step brother, stepmother, that's okay.
Or if I had a husband, which don't, but if I had a husband and he wanted to exchange with John, then he could, because he's not related. That's not a related exchange either. An in-law,
And uncles, aunts.
Correct.
And
Uncles
how about?
Yeah, you can still exchange with an uncle or an aunt or a cousin. Not considered related for IRS purposes.
Okay, thank you.
Related parties are lineal descendants, which would be mother, father, sister, brother, son, daughter.
Perfect. Thank you for clarification.
Business entities with more than 50% ownership by the exchanger. So in essence, if I own an LLC with a partner and the partner has 50% and I have 50%, then I don't have control over the partner. And so the IRS does not consider that a related party. If I have 51%, then that LLC is a related party to me if I own 51% of that. Anything more than 50%, then it's considered a related party. And, fiduciary relationships, trust, if I own a trust and I'm not the trustee of that trust, it's still considered a related party because I'm the beneficiary of that trust.
And affiliated businesses controlled directly or indirectly by the exchanger.
Yeah, I think a lot of people ask, if I have an LLC, can my LLC or my corporation own a business property? Can I just sell something and buy something from my business? I think we get that a lot.
We do. And you cannot exchange with a related party. So if you own 50% and your wife owns 50% and your wife is related to you, then it's a double related party. I mean, it's just totally inappropriate for you to try to buy a property from an LLC that is owned by you and your spouse.
That was good clarification.
We get that a lot. Why don't I just buy a property that I already own? Well, because you can't buy a property that you already own.
People don't like that answer, I don't think.
No. Okay. Selling relinquished property to a related party. Can we do that? So the taxpayer can sell their relinquished property to a related party and buy a replacement property from an unrelated party without violating the related party exchange rules. And I'll just add one caveat to that. The related party that you sell to has to hold the property for at least 2 years before they liquidate the property. If you've made a deal with the related property that he's just going to turn around and resell the property that you sold to him, then your exchange will get voided and they'll want to claw back the tax that you didn't pay.
So on to this one will be buying a replacement property.
Yes. Can the exchanger buy a replacement property from a related party? Sarah?
So typically not, however, the replacement property can be acquired from a related party in very limited circumstances. So taxpayer transfers a relinquished property to an unrelated party, which is the case in almost all exchanges. The taxpayer should not acquire the replacement property from a related party unless these are the two exceptions that we've got on here. The related party is also doing an exchange, or the related party is paying more tax than the taxpayer is deferring in the exchange.
So in item number 2 there, the related party is paying more tax than the taxpayer, and that would be equal or more tax than the taxpayer would have paid had the taxpayer sold his property without trying to effect an exchange. So if the tax that I would normally be paying without the exchange is as much, let me turn that around. So if I'm buying from a related party and he's going to cash out and pay his tax, and that tax was as much as I would have paid on my property had I not sold it to him, then the IRS will allow me to buy a replacement property from a related party. And the related party then would have to pay tax on his sale. And that as long as that tax was more than the tax I would be paying. And you see how that kind of cuts out the opportunity for him to shift a high basis property over to me for a low basis property. So we've done a few of those, but generally, if you're trying to buy from a related party,
it stops there.
Yeah.
Yeah, they don't. That's generally not how they want to structure it.
Yeah. And so there are related parties that will say, okay, you can buy my property from me because you've always wanted it, and I'm going to let you buy it, but I'm not going to want to pay the tax, so I'm going to exchange also. So now you've got this daisy chain of exchanges, which is okay because the IRS is not getting cut out. They're getting the opportunity to get their money later on. If
John,
the
this
taxpayer
may not
eventually
be.
pays it. Go ahead, Michelle.
Sorry, this may not be a question that you know the answer to, but do you have any insight? Because I think this question might come up a lot, but do you get any insight onto how the IRS knows? Like, how are they cross-checking whether or not the related party could have paid more tax, or any insight on that?
Yeah, so on the tax form, on your 1040, which is your tax return, or your 1065 if you're filing a tax for a partnership LLC, there is a question right on the tax return that says, have you sold in the last 12 months or since your last tax return, have you sold a property to a related party? And if you check the box, then the IRS flags that, and they look and they automatically pull and compare your related party's tax return. And so it's an easy task for them to determine that you have bought a replacement property. And if they see that the person that you bought from did not do an exchange but just cashed out, then it's gonna be an automatic audit on your exchange.
Thank you. I appreciate that insight. That was, I think people often question about how do they know?
Yeah. And so, I mean, you can't, if you don't check the box, then you're holding yourself open for tax fraud because you're not telling them that you purchased the property from a related party. You have to give on your tax return, you have to give a detailed explanation of why you think no tax would be due and why it's okay for you to buy from a related party. There has to be a addendum to your tax return, which will be a written narrative that would allow the IRS to see why you think that it's okay for you to do the exchange with a related party.
That's helpful. Thank you, John.
Yeah. So now these are the two exceptions. So now we're talking a little bit about the 2-year holding period. Tax Reform Act of 1984 introduced critical safeguards for direct exchanges between related parties. In a direct swap, where parties are exchanging simultaneously, both parties must hold their newly acquired property for at least 2 years. Early disposition triggers immediate taxation of the originally deferred gain. So what does that mean? In other words, if you've got a related party, maybe your sister or your brother, and you two want to swap properties, then that's okay. That's a simultaneous exchange, which does not require a qualified intermediary, and neither party has to pay tax. But if either party liquidates their new property within 2 years of acquisition, then it voids the exchange for both parties.
Okay.
And there are several exceptions to that. If there was a forced eminent domain or a natural disaster that required you to sell or liquidate the property, or if the IRS determines that the transaction wasn't structured to avoid tax. Okay, so these are some of the related party rules that we deal with on a regular basis. If you are buying or selling from a related party, you have to be careful and go over those rules with your qualified intermediary to make sure that you're staying within the guidelines. And we can, of course, under certain circumstances, create an effective exchange with a related party, but we have those circumstances we have to meet.
Yeah,
Okay.
I think that touches on a lot of the related party, and I know that we put some other slides in here just that are other considerations when exchanging, because this comes up a lot
Well, this
about
is
same
part of the
taxpayer and same title. So if
Yeah.
anybody, this might be a good place to stop if anybody has any questions about that related party, the 2-year hold period, lineal descent, any of that. I think, John, you were very, very clear on a lot of the points. But if there's any questions that you might have, we can certainly answer them. Otherwise, we can just move on to other considerations.
So this one, other considerations, this is kind of like a related party thing. Same taxpayer, right? Continuity of title. It is important. It is an important component in any 1031 exchange to qualify for tax deferral under the 1031 program. The same taxpayer who owns the relinquished property must be the same taxpayer who purchases the replacement property. So if I have an LLC, for instance, that I want to buy the replacement property, and the LLC is a partnership LLC, then that would be a different taxpayer, because any LLC that's owned by more than one person is considered a partnership and therefore a separate taxpayer. Same taxpayer that sells the relinquished property has to buy the replacement property. So you need to check and see who owns the property that you're selling. Is it you? Is it you and your spouse? Right? Is it
There
an
have been,
LLC?
I think that there have been cases where the taxpayer in the title, the taxpayer who's reporting the taxes, is not the same as who the title is on the deed. So in that case, and that does happen, so it's not that it's uncommon, what would you default to? Who would be ultimately the exchanger?
Taxpayer.
Go ahead.
Taxpayer
Yeah.
would be the exchanger.
I think, Michelle, correct me if I'm wrong, but what you're getting at is a lot of times accountants don't pick up the fact that the husband and the wife together own an LLC, and they're both considered members, and the accountant just puts the ownership in one of the two parties for tax purposes. So they don't recognize the LLC as a separate taxpayer, and they don't file a separate return for the LLC that owns the property.
Yeah,
And
and I think you see it a lot with people that have trusts too. So if you pull the deed, the trust may show up as the title holder, but there's no tax return for that trust because it's a disregarded entity.
right. And if the trust is the owner of the property, and the trust is owned, the trust is the beneficiaries of the trust are actually the taxpayers. So the income from the property that you are relinquishing or selling is reported on the 1040 on the personal return of the individual. So the taxpayer would be the individual, not the trust. And so the exchanger would be the individual, not the trust. Now, that gives the opportunity for the exchanger to put the replacement property either in their name individually or back into the trust that sold the property and that sold the relinquished property. Same thing with a single member LLC. A single member LLC is considered a disregarded entity for tax purposes. Single member disregarded entity. And if the property is owned by an LLC that's a single member disregarded entity, then the exchanger is going to be the individual that owns the LLC. Now, when the individual goes to buy his replacement property, he could, especially like if it's a residential property and he wants to take advantage of Fannie Mae or Freddie Mac financing long-term 30-year, then he could buy the replacement property in his own name and then eventually transfer it back into his LLC if he wanted to, or leave it in his own name, even though the original property was owned in his LLC, because remember that LLC is disregarded by the IRS. Am I making sense?
Yeah, and I think that it gives, it shows that there's a little flexibility there when you have a disregarded entity.
Right. So, it gets tricky when you've got husband and wife owning an LLC together. So if it's not treated as a separate taxpayer on their tax return, then we have the owner that the CPA that does their returns chooses as the owner of the property, and we have that owner as the exchanger. So what happens if you own a property? Let's say Sarah owns a property and she's married and she's going to sell that property and buy a replacement property. And Sarah's first question to me is,
Can I put my husband on the deed? My husband.
Right.
That was a thick accent there, Sarah.
I was trying to do something fun. So you can't do that because it diminishes your ownership interest by 50% when you add a spouse, unless you're in a community property state.
Right.
Then
Now,
then it doesn't matter.
there are 7 community property states, but neither Massachusetts nor any of the states surrounding Massachusetts are community property states, except Rhode Island. I think Rhode Island is. And so if you live in a community property state, then regardless of whether you own the property by yourself or you own it with your spouse, the IRS sees it as as owned by both parties.
Unless you buy up in value.
Right.
Then you could add them. You know, if you sold a $500,000 property and bought $1 million property, then there's no issue there.
You could add your spouse because you're buying $500,000 and the spouse is buying $500,000. So you've satisfied your exchange. Okay.
That's kind of the end. Which is perfect because we typically try to go for about 45 minutes. We're at 12:40 now, which gives us a few minutes for any sort of questions, but you can certainly go through the QI due diligence.
Any questions at this point?
See any popping up in the chats? You can certainly unmute if you'd like, or pop up in the chat if you'd like, whatever you prefer. Quiet group today.
Mm-hmm.
Normally we're flooded with questions. Everybody's getting into summer mode. That's what it is.
Related.
Yeah.
Related party.
What is the overall take? I guess the overall take is if you're trying to do a related party exchange, then call us, maybe. Or what would you say the overall?
I think that you have to be very careful if you're buying property from a related party. In almost every circumstance, it's not going to be allowed. And, just those 2 rules, you have to, the related party also has to be doing an exchange, or the related party plans on paying more tax than you were going to pay on your sale. And, generally when you're buying from a related party, that you're trying to avoid paying the tax. And so those 2 don't work. Those 2 loopholes, or those 2 exceptions to the rule don't work. Yeah, don't apply. Yeah. So I think that, due diligence, we talked about every exchanger needs to do their due diligence. In other words, don't choose a QI just because you saw them on the internet. Make sure that they're a reputable organization, that they've been doing business many years, that they are members of the Federation of Exchange Accommodators. That's our trade association, which requires us to abide by ethical standards and business practice standards that non-members don't have to worry about. Also, having a bank-owned QI, do your business, means that you are using bank systems to make sure that you have state-of-the-art fraud protection. Big problems with wiring money these days to bad players that are going to try to steal your wire funds. And Northern Bank, along with most of the banks that are federally regulated, have state-of-the-art fraud protection so that your funds are locked up and secure. And I think that's an important aspect of making your decision about who you're going to use for your QI.
So I'm just popping John's contact information up here, my contact information. You can certainly reach out if you have any questions. And And I think we're going to just wrap it up. So I want to thank John and Sarah for this presentation. Feel free to hang on for a few minutes afterwards if you want to chat kind of privately. Otherwise, we're going to disconnect and we'll be sending this presentation out to you via email in the coming hours. So thank you all for joining.
Appreciate it.
Thanks, John. Thanks, Sarah.
Thank you, Michelle.